So risk management is very central to what you do, and in your previous answer you explained it quite well, that for a fund such as yours to see a drawdown, thousands of trades have to go wrong in a very short period of time, and it does happen once in a while. If I were to move on and see the other side of it, and if we move on to how does performance happen in a fund such as yours, do thousands of trades have to go right for longer time frames? Is that how the fund performs? What are the real drivers of performance for a global quant trading fund such as yours?
Let me give you a brief idea about how typical quant fund like ours works in terms of basic success and failure, right? See, on an average, for different quant number funds, its number is different. But what, as I told you, we take thousands of trades every day, right? Out of those trades, right, on an average, the success of those trades is 55, 60. It's somewhere between 55 to 60%, different for different quant funds. For us, it's closer to 55 than 60, I'll be very honest. And then how much you make when you are successful and how much you lose when you are wrong. Right? So let's say if your 55% trades are successful, 45 are unsuccessful, how much you make in your successful trades. So on an average, we make 2.5 times in a successful trade as compared to what we lose in a loss-making trades. So this capability of putting very small amount of risk on every trade that we take, but if the opportunity presents itself, we ride our trades, we continue with our trades. So let's say if I'm, so what happens, let me give you, what days are our best days, right? Let's say market opened in the morning and we took a trade, certain probability happened and we took a long trade, right? And when this long trade probability happened, like let's say for the rest of the day, whatever patterns, that strategy, whatever patterns are coming, whatever data is coming, keep saying the probability is to keep long, and stay long in that entire day and capture a good amount of profit. Right? These are the days when we make a lot of money. When a big movement happened in a very short time period of time, and our models actually just rolled on that moment. You don't have to exit a trade, and you just continued with the trade only. So this asymmetry in our upside trades versus the downside trades, like we make 2.5 times in a winning trade versus what we do in a loss-making trades, and along with 55% success rate, these two combined together creates a very consistent return streams, which maybe a couple of times in a year loses consistency, but for the most part of the years, it shows big consistency. So this asymmetry where we make closer to 2.5 times in terms of what we lose in the loss-making trades, this along with a very reasonably high success rate of 55%, these two combined creates a very powerful, consistent money-making machine. And the idea is to keep working on making sure that our success rate improves or win to loss issue improves. The entire research or entire machine building at our end goes behind these things only to improve these two numbers so that we become more consistent, give higher returns to our client. And as I mentioned, right, there are phases where we get a very good run and we make a lot of money. So when I say consistent, it doesn't mean that it's like an FD, right? 0.5% interest every month. It doesn't work that way. They are typically let me put more color to our performance, right? Not typically happens when we run all these things together, right? There will be 3 to 4 months in a year, which typically will be your annualized returns. There will be a couple of bad months, and then there will be other 6 months which will be flat to positive, which will cover for the 2 bad months losses, and those 4 months which will be high return, typically double-digit return months, which will be driving your annualized returns. Though we do behind the scenes a lot of work to bring consistency, even after that, it's as good as the opportunity presents in the market, right? So another thing that since we are such an active firm, right? We do thousands of trades every day. It means we pay a lot of exchange fees, we pay a lot of brokerage fees, we pay a lot of STDs. So we pay a lot of charges in our trades. So what happens when market is not doing anything, we are still entering and exiting, right? We are paying all these fees. So it's not like every month I'll make money without any opportunity present itself in the market. But what we try to achieve is to have good 4 or 5 months in a year instead of saying good 4 or 5 years in a 20-year cycle, or is like good 4 or 5 months in an annual cycle. And you have a couple of bad months. There's no denying about that part as well. Typically, it happens when there's a lack of opportunity and we're end up paying a lot of cost. Sometimes a drawdown triggered by our cost only, not even by bad performance or by negative P&L. It's just triggered by thousands of trade ending in flat, and we pay a lot of cost on those trades. So sometimes even drawdowns are triggered by that as well.
And while you've very aptly explained that it is essentially the percentage of winning trades and the reward against every rupee of risk. So if the reward is 2.5 rupees for every rupee of risk, and if the percentage of winning trades are 55% or more, it would end up giving the performance that the fund can deliver.